What's up, guys? I'm Nobody Special. I got my man, the moderator, Mish, right here. We are poolside. It's a beautiful Sunday morning out here in Pennsylvania.
So Jack got this nice message from Cheeseburger, our friend.
That's my man, Matt. By the way, he was the inspiration for the MMMRI video with Cheeseburger. So thank you, Matt, for everything you do for the channel, brother. And he left a great comment on the last video that we just did about the housing bubble bursting, about what happened to MBSs because of the inflation read on Friday. And there was so much in there, I just like, we got to do a video to answer this comment. Why type a whole dissertation? So
what I'm going to do is I'm going to read the whole thing, and then we'll go back and ask the specific questions. We also learned about New Zealand and their real estate market in here, so that's kind of cool too. Okay, so here's the whole clip. Hey Jack, a few questions. How do the increasing interest rates affect people who bought their homes a couple years ago? Do they need to get reamed when they got a refi? In New Zealand, our mortgages are usually only fixed rate over up to 5 years. Then you got to refinance after that. Is this similar to the adjustable rate in any way? Also, a lot of people suspect that the likes of BlackRock will sweep in and buy up property as the average buyer gets pushed out or people are foreclosed on. However, Ninja doesn't think that BlackRock can come through and buy up the foreclosed properties. Do you understand his reasoning for this, and do you agree? And lastly, I will let you discuss the lastly at the end.
So we got a lot to unpack in this comment. First of all, this was a super chat from the Cheeseburger. So thank you so much, Cheeseburger, for your support of the channel. I really appreciate that. And also, now I always learn something from these comments. I didn't know that about mortgages in New Zealand, that they don't have 30-year fixed in New Zealand. The interest rates, and I verified this, the interest rates in New Zealand are only fixed for 5 years, and after that it's a floating rate mortgage, which, yeah, that is the same thing as an adjustable rate mortgage or an ARM here in the States. I was really surprised to learn that. So give me that first comment again, the first line here.
So first, how do the increasing interest rates affect people who bought their homes a couple years ago?
Okay, so the good news there, if you bought your home a couple of years ago, these increasing interest rates don't affect you. All right, that's if you're here in the States with a 30-year fixed rate mortgage. You've locked that in for 30 years, so that's awesome. All right, now if you are in Cheeseburger's position, if you got that 5-year fixed rate and you bought 5 years ago, well, your payment's about to go up because your teaser rate is about to expire. And I don't know for sure what interest rates in New Zealand have done. I'm going by the assumption here that they've gone up like the States have gone up. So your payment's going to go up. All right, so that's tough. Your affordability is coming down. Your payment is going up. Now, I need to put a big asterisk on there because I said people here in the States, you're not affected by these rising rates. And that's true. If you bought your house, say, in 2018, and you got a 30-year fixed rate mortgage, your payment's not going up. However, in this interest rate or in this inflationary environment here, your gasoline is going up. Your electric bill is going up. Everything, your food is going up. Everything else is going up. And it's going up faster than your income is going up. So even though your mortgage payment may not be rising too much, also your property taxes are probably going to go up because the governments are going to give themselves a raise. So while your payment may not be going up, everything else is. So if you're like a lot of people and you bought as much house as you could possibly afford in 2018, guess what? In 2022, you can't afford that much house.
Okay, so
you're in a tough position there.
So sorry to interrupt you there, but what we have here is I looked up the New Zealand rates, and the 5-year ARM rates are right comparable to our 30-year rates. So a 5-year adjustable, it starts at 5.85.
Which is pretty much what a 30-year fixed would start at here. So your rates, you're in a similar position here in the States. All right, what was the second part of that comment?
Okay, do they need to get reamed? I'm not sure what reamed means.
Reamed means financially brutalized.
Oh, really? Do they get reamed? Okay, got it. Do they get reamed when they got a refi?
Yes, unfortunately. If you're forced to refinance in this environment right now, chances are you're refinancing from a lower rate to a higher rate. And that's why refis are dropping off a cliff right now. Nobody's refinancing their house unless they absolutely have to. And that's the thing, when you hear about refis are down, refis should be at 0 right now. Nobody should be refining right now. So if you are refinancing your home, chances are you're being forced to, which means you're probably doing a cash out refi, which means you're taking equity out of your house for cash. Now, of course, when you do a cash out refi, your monthly payments are going up. So you immediately need to start using that equity that you've cashed out to pay these higher payments, probably so you can avoid foreclosure, or you're hoping things improve a year or two down the line. Which means what you're really doing, if you're doing a cash out refi right now to make your home more affordable, you're just slowly selling your house back to the bank. That's what you're doing. You're spending your equity. It's not going to end well for you. So people who are refining right now, chances are they're doing it out of desperation, and they're refining into a higher monthly payment. It's not going to end well.
And kind of add on to that, someone asked recently who's buying houses right now. I will tell you that the military moves about 1 million people a year, and that's all branches together, moves about 1 million people a year from city to city. And a lot of those people are selling houses and buying new houses. And that's happened on a year-to-year basis. So right there, that's 1 million houses that are being either rented, not rented, bought, or not bought. So there are organizations out there that are moving people that you don't necessarily see. So there is a stable underneath floor to this.
Right, that's a baseline. That's not an increasing trend or a decreasing trend. That's a baseline, home sellers and buyers.
But there are people out there buying, and that is why. I'm gonna get back to the comments.
Now let's get back to Cheeseburger's comment. What was the rest in there?
Okay, so in New Zealand, our mortgages are usually only fixed rate up over 5 years.
We talked about
then
that.
you got to refinance. Is that similar? We already talked about that.
That is similar to an ARM here in the States, which ARMs are on the rise, by the way. A lot more people are getting adjustable rate mortgages now. Let me talk about that real quick. An adjustable rate mortgage, that was part of what caused the problem with the global financial crisis, is everybody took out adjustable rate mortgages, and then interest rates rose. Well, those teaser rates expired, and now your payment is higher and you can't afford it, and your home gets foreclosed on. So adjustable rate mortgages are very risky. Now, people supposedly are taking out more adjustable rate mortgages now. I saw an article on CNN just yesterday talking about how it's a way you can afford more house. Well, keep in mind, there's two ways this could play out, right? We could have the scenario where the Fed pivots, like I expect they will, and they turn the printing presses back on and they lower interest rates again to save the economy. In that environment, an adjustable rate mortgage is a good thing.
Yeah.
Because by the time your teaser rate expires, the rates have been lowered, so your floating rate comes down, your payment drops when that happens. However, stranger things have happened. The Fed could adopt a responsible policy, and they could say the only way to truly fight inflation, they could, let's not rule it out, we're in the realm of all real numbers here, they could leave rates higher for much longer, and they could continue to fight inflation at the expense of the economy. And if you've got an adjustable rate mortgage and your teaser rate expires when the Fed is doing that, you are wiped out.
Gone.
Gone. Because you will not be able to afford. We could get Paul Volcker's interest rates again, 20%. Imagine what your home payment would be if interest rates suddenly went to 20%.
Even if they just went from 3 to 5% is what we figured out on Friday was $400 a month. Who can swallow a $400 a month increase right now?
Very few. Not with gas doing and food doing what it's doing. So if you are taking out an adjustable rate mortgage right now, understand what you're doing is you're rolling the dice and you're banking on the Fed coming to bail you out, i.e. the whole real estate market. And if the Fed doesn't do that, if they go the other way, you're wiped out. Keep that in mind. I would not touch an adjustable rate mortgage because I don't like making that big a bet on a binary. It could go one way or the other.
Yeah. There's a show I watch called Critical Role, and they have a game called Rollies. It feels like you're playing Rollies with J-Pal, right? Roll and see who's going to win on a dice. That's kind of your gamble right now, is you're rolling against the Fed on those arms.
Don't fight the Fed.
Then he also talked about BlackRock. Ninja has talked a couple videos about this. Don't want to put words in Ninja's mouth, and so he can talk about this if he wants. But Ninja's come out and said that he doesn't think BlackRock's going to come and save the real estate and buy up all these foreclosures, and that's what he's asking our opinion on that.
Okay, so first of all, we'll let Ninja answer for himself. Hey Ninja, why don't you do a response to this video and definitely tag us so that I can crush Chris Taylor in that video. But I agree with Ninja here that I don't think BlackRock will ride to the rescue. All right. So first of all, BlackRock is in the real estate business right now because they're chasing yield. All right. BlackRock has all the baby boomers' money, and baby boomers need fixed income. They need yield. They would typically get that in the bond market, but the bond market is not providing that or at least it wasn't providing that. Rates are rising now, so that trend is changing. So they're going to buy residential real estate so that they could rent it out, and that rental income is the yield that the baby boomers need, that yield they would typically get from a bond. Now, right now, the bond market is becoming more competitive with real estate because yields are rising. So BlackRock may be incentivized to pivot away from that real estate transaction. The other reason why I don't think BlackRock is going to ride to the rescue is because, number one, BlackRock has to preserve their capital at all costs. If they're buying homes that are going down in value, forget the yield, they're losing their principal. So they won't do that. And the other thing is, we learned with Zillow, Zillow almost went bankrupt with that stupid, what did they call it? Zillow buys your house or whatever.
8 or 9 months ago is when they really were in the deep.
Because flipping homes, that business model doesn't scale. You can't flip homes on a large scale from a central office in New York or Texas all over the country. You can't do that. It just doesn't scale. Flipping homes is a small business that needs to be run really locally, where you need to have eyes on each individual property. You just can't scale up that business. And I think BlackRock is going to learn the hard way that this foray into residential real estate that they've made these last few years is probably going to go the way of Zillow's foray into residential real estate. I don't think it's going to end well for BlackRock's customers, their clients, i.e. us.
Yeah. All right.
Now, Ninja, if you think differently, if I got your logic wrong, by all means, do a response. Let us know what we got wrong.
Okay, and then lastly, can you change your channel to the name Jack's Financial Fitness Ninja Dojo?
Jack's Financial Fitness Ninja Dojo. Let's do it. Let's do a rebrand. We're chasing Chris Taylor right now, Financial Prepper. I'm coming for you, Chris. I'm coming for you. You better get at least 500 out in front of me. That's all I'm saying.
We've almost got 300 this weekend. We're coming for you.
Chris Taylor over at Financial Prepper and I, we have a little gentleman's bet going. We're very close in subscriber count. And Chris passed me recently. It was a very emotional time for me.
It was.
Very difficult.
You got very upset.
I'm reeling emotionally right now.
A little bit of a tear went down.
But don't worry. But we must press on because we're making videos right now, aren't we?
We are.
Chris, are you making a video right now?
I don't think Chris is making a video. I think he's laid up somewhere.
Being at the top, you get complacent. I can't blame him, but I'm coming for you, Chris. We're going to crush you, brother.
All right, remember to spay and neuter your pets.
It's like having Bob Barker right next to me. It really is. We need to get you one of those really thin microphones. With
the ones that you just held out from here?
Yeah. All right, guys. Thanks again, Cheeseburger, for the inspiration for this video, for your support of the channel, and everybody else for all the comments and questions you send me. And until next time, live small and dream big. And we're out.
Wow.
That's a wrap.
How was that?
That was good.
How long was that?
Too long, but it's good enough.
Well, I don't think it was. How long is too long? It was like 15 minutes.